Can ETFs protect against a drop in the markets? August's been a volatile month for stocks. A large cohort of older investors has created a demand for products that allow investors to still stay invested, but provide some downside protection. Now, how does this exactly work? Let's talk with Bruce Bond. He's the CEO of Innovator ETFs. Bruce, good to see you. These buffered ETFs you have, they're going to provide partial downside protection and still provide and allow someone to stay in the market. Explain how this works. I know they're monthly. They change every month. Explain how, for example, the August power buffer works. What kind of protection do you have?
Okay, yeah, thanks for having me, Bob. Basically, on the August, PAUG is the symbol for it. You have 12.5% upside, and you have a 15% buffer. Now, the 15% protection on the downside is your buffer. And so if the market goes down from 0 to 15, investors don't lose anything. It's only if it goes down to 16%, then they would lose 1%. That's basically how they work. We sell off some of the upside opportunity in order to protect them on the downside. It's an options portfolio.
Right. So for August, the maximum upside, I'm going to repeat this, you participated 12.8% on the upside for the S&P, and you protected down to 15% drop in the S&P 500, right? So there's one for the start of every month.
That's exactly right.
The August buffer is meant to be held for a year, essentially, but you can buy it at any time. The price may change, but you can buy that August one or the July one anytime in the next year, right?
Exactly. So let's say you want to, we encourage people to start around the beginning of the month if they don't want to go to our website and check out where the value is, just to check it. But yeah, so you could buy the PAUG, you could buy the PSEP for September, P December, PDEC. So that's how they go through the year, P November. And so that's how you know what you're buying. So if you get right around the beginning of the month, you can look at our website and you can see what your cap is. And you always know that you have a 15% buffer, which is the protection on the downside. And this is ideal for, investors that have their retirement. They're looking to be in the market. Maybe they have a lot of cash on the sidelines. They're looking to get to work in the market, but they're scared of the market.
You know, you're doing this, it's quite a remarkable product. You're doing this, though, using options, a number of options. And options are expensive. The cost for this is 0.79% a year, 0.8%. That's fairly pricey. Some people looking at this might say, isn't it a better option just to rebalance, essentially, just sort of lower your exposure a bit rather than pay a lot of money to have these fancy options that you have? What do you say to people? Say there's an easier way to deal with the risk associated?
Well, if you think about it, a lot of people took their money and they had it in bonds here recently, and they got hurt really bad by allocating to bonds. And so just keep in mind that this is another way to have safe assets. This has roughly half the risk of the S&P 500 in it. So it allows investors to stay invested, stay in the market. Now, each year, yeah, you'll hold it till next August, but then it resets. It gives you a new 15% downside protection and a new cap, and you just continue to do this over the years. It's not necessary for investors to do anything. You just stay in it, and each year it gives you 15% protection on the downside, and it gives you a new cap. It's very easy to see what the cap is if you want to check it out. So that's really how it is. And yeah, I will tell you, people have looked at building this themselves. Could they go build it themselves? They could try to if they're familiar with options and how options work. But there is no way that they're going to be able to do this at the level we do it at and for the cost we do it at. And so it's very, very difficult. As you said, options are expensive. We do this at the institutional level. We deliver that to investors in an ETF, as most know, are very efficient.
Bruce, thank you very much. Appreciate that. We're going to have a lot more on buffered ETFs and how to protect yourself in a downturn coming up on ETF Edge. That's 1:10 p.m. Eastern Time. Bruce is going to be joined by Mark Higgins. He's the Senior Vice President at Index Fund Advisors and author of the new book, Investing in U.S. Financial History, Understanding the Past to Forecast the Future. It's a great book. We'll talk about that. It's etfedge.cnbc.com.